Welcome to the J.D. Levy & Associates Calibration Point Podcast. Our podcasts are designed to bring a conversational exploration of key topics that we believe will provide value and insight to those serving in the nonprofit sector. We will highlight new developments in the field, latest research, and things we're learning from our own clients that we can share.
I want to welcome everybody to this month's episode of the Calibration Point Podcast. And I have with us a return guest, but now in a slightly different capacity. And I have Zac Kester with us. And Zac is now the Executive Vice President at Donum over charitable gift financing. And Zac, as you and I were just talking about the transition you've made coming out of the legal field and now taking on this new initiative, I just was really fascinated with what you're doing, and it opened my eyes a lot. Like, I had kind of thought about or seen maybe little pieces of what you're now doing, bringing the whole picture together, but never, and you could speak to it. I don't know that anybody else is doing this, but I've never seen the whole kind of table get set in the way that you're doing it. So for everybody listening, as I was exploring this with Zac, I was like, oh, wow, I got to have Zac come on the show and share this really just unique thinking, understanding, and concept around charitable gift financing. So I'm not going to allude any more to it, Zac. You just take us where you want to go.
Sure. So charitable gift financing has in some form or another been around for decades, but there are a few different, in fact, three, to my knowledge, private debt funds that exist to facilitate charitable gift financing loans.
Okay.
Well, what is charitable gift financing? It is kind of what it sounds like. It is loans where high net worth individuals, or you don't even have to be all that high net worth, you just kind of upper middle class or higher, you take out a loan to finance your charitable giving. So, and then what happens is the tax savings wind up being such that they can more than repay the loan, the financing itself, over the long haul. So let me give you an example.
Yeah.
Let's say that my wife and I are let's say, a ideal borrower. Let's say our household adjusted gross income is $300,000, just a very round number. That's not uncommon for a household with a couple of, professionals or something, as
Right.
Where they both work in that kind of setting. So our adjusted gross income, this is a hypothetical, by the way. I'm not actually sharing what mine and my wife's income is.
Don't worry.
This particular couple, their household adjusted gross income is $300,000. And if we do the math, and depending on their federal tax bracket and the state they're in and the state taxes, and if there's any locality like county or city taxes, and I'm talking income taxes now. Let's say that in this particular jurisdiction, this couple, they pay exactly 33% tax. That winds up being their effective tax rate.
Right.
And it's just because of, you add their state income tax, their federal income tax, and then any locality income tax. Their particular tax this year is 33%. So what does that mean? That means if they have $100,000 of adjusted gross income and a tax rate of 33%, they pay $100,000 in tax this year. I'm obviously rounding, but $100,000 of tax. Now, what if that couple could take a $100,000 loan and could finance that loan on favorable terms? And what they did with the borrowed money is make a donation to charity. What would the effect of that be? They would effectively reduce their adjusted gross income down from 300 by 100 because they borrowed and donated 100. So now they would be taxed on $200,000 instead of $100,000. So the tax savings to them then at 33% on that $100,000 loan would be $33,000. So the question is, what do they do with that $33,000 in tax savings? Well, basically three things. A portion of it is to pay for an origination fee for the loan. Another portion of it pays for their collateral that they have to put up. In this case, it's life insurance. And the rest of it, they get to do whatever they want with. How it turns out mathematically is something like 20% or so of the tax savings they wind up getting to use for their own purposes. So they can do whatever they want with it, right? It's their money to do whatever they want with. They can invest it. They can use it for household expenses. They can use it for payments towards a vacation home or a car. It doesn't really matter. It's their money. They can do whatever they want with it. Around 20% of the tax savings. So in this example, $6,000 or $7,000 would be what they would be able to use. But then the remaining $27,000 is used to pay the origination fee as well as the collateral. So that collateral is a fully prepaid upfront life insurance policy that they own, but that the primary beneficiary is the lender. And so the loans are often or usually what's called non-recourse. And what that means is that the lender can't collect against the personal assets of the borrower. They can only collect against the collateral, which here the collateral is a fully prepaid life insurance policy. So the interest accumulates on the loan and the principal and interest becomes due at the end, at the death of the borrower, and there are no payments due between the date of the loan and the date of death. It all just accumulates on the note over time. And the life insurance policy and indexed universal life insurance policy increases in value over time and eventually is in excess of the value statistically is in excess of what's owed on the loan. And so ultimately then the life insurance collateral winds up paying the amount owed on the loan. And the reason why the loan is non-recourse is because you may say, well, what if I die early and the policy hasn't quite caught up to the full principal and interest yet? Well, that's why the loan is what's called non-recourse, meaning that the lender cannot collect against anything except the collateral and only the collateral.
Oh, wow.
So it means that the risk of that happening is being borne by the lender and the life insurance policy. It's not being borne by the borrower. So what's fascinating about this is that ultimately the lender is ultimately charity. A charity is the lender. And that means the returns, the interest on the note and the principal on the note as they're repaid go back to charity in the long term. So in the short term, the person got a tax deduction because they donated to charity. The borrower got a tax deduction. But in the long term, as the principal and interest is repaid at death of the individual borrower, then the charity who was the lender they receive capital in the form of principal and interest that is being repaid on these notes. And then that creates sort of this exponential increase, if you will, for the lender, the charity that is the lender. And what Donum does is Donum facilitates those loans and manages the LLC that the charities are the investors of. And so then it's in essence the charity, Donum being the lender, and that's why I work Donum, but the returns go to the charities who are the investors in Donum. And so that's kind of how that works for the charities and the benefit for the charity. But the benefit for the borrower is the two things, the short-term tax savings, as well as perhaps more importantly, the fact that they know they have exponentially increased the amount of philanthropy and charitable dollars available. As you probably know, Jamie, when donors give cash, which is borrowed money is cash. When donors give cash, they are allowed to deduct up to 60% of their adjusted gross income as a charitable gift. Depending on a few other factors, but the typical borrower in America gives between 2 and 6% of their AGI in any given year. Now that there are life circumstances that can sometimes cause that to spike, but on average, it's usually in the 2 to 6% range. So that means that if a household has income of $300,000, adjusted gross income of $300,000, they're probably only giving between $6,000 and maybe $18,000 at most, and that would have the effect of reducing their AGI by about that amount. But they could give up to 60% of $300,000, which in this example is $180,000. So even if they're already giving 120, they could still borrow up to an additional 120 and would still be below the 60% AGI. So those are the deduction limitations. And we at Donum, we have borrowers as well as the other charitable gift financing firms that exist. We have borrowers who come back year over year over year because they like reducing their tax bills on one hand, but on the other hand, and perhaps more importantly, they love giving philanthropically. They love that they wind up enabling large amounts of charitable capital to be unleashed on the charitable sphere in a way that was not able to be unleashed before.
So just to make sure I'm hearing this right as well, there was a third benefit I thought I heard you say, and that is that there's a potential that the life insurance policy's payout is higher than the obligation of the debt service to Donum, right? So there is the potentiality that the donor who does this, that their heirs could end up with some margin, some percentage of that life insurance policy growth over the debt service to the charitable advisors. Did I hear, or the financier? Is that right?
You did, yes. You heard that.
Okay.
You heard that correctly. We at Donum are careful not to position this as an estate planning play because it's really not. But there are a number of circumstances when we just sort of do the arithmetic where the total death benefit under the life insurance policy exceeds the total amount owed on the loan. And if that's the case, then the first thing to get paid is the principal plus interest on the note. And then what's left can go to the beneficiaries who were the secondary or tertiary beneficiaries who were listed on the policy. Which of course the borrower gets to pick whoever that is. It could be their spouse or their children or what have you.
So it would seem, and I totally respect why you're not promoting that as a benefit, but it seems to me then if the average family in the United States that engages some charitable beneficiary in a will is mid 40s, someone who puts you in their will after age early 70s is something like 1,200% more likely to take you out before they die than someone who puts you in their 40s, 50s, and 60s. It seems that what you're doing, while it's not positioned as an estate planning tool, there's a lot of incentive for someone to be this strategic earlier in their life.
Yes.
Because of the potentiality that there could be another capital return to some beneficiary. And I totally respect that that's not what you're positioning, but just from running the numbers, it would seem that would make a lot of sense.
That's correct. And as you probably, as we could probably all guess, the cost of insurance, of the insuring of the individual is less when they're younger. Right? Because just math, right? The only thing guaranteed in life are death and taxes, right? So we're all going to die. And the older we are, the closer statistically we are to that moment when we pass away. And so to your point then, if someone's in their 40s when they take out a charitable gift financing loan, the ability of that policy to grow, for the returns within that policy to grow, and the odds that policy would overperform the debt service is higher.
Yes.
Yeah.
Okay. So let's then talk about, I want to get to the charitable organization side, the lender side in a second, but I'm still, just for our listeners, want to unpack the charitable financier side. So the donor who wants to make the gift. So let's talk about risk mitigation. So I do this, say, in my 40s or 50s, whatever it might be. And as income reduces, then my marginal tax rate will reduce. How does that factor in to the calculations that you do? Just using our hypothetical, but it's a good one, $300,000 AGI. If that AGI drops to 200, is there ever a point in which the tax benefit no longer outweighs the cost of the service of the loan? Like, what do you find there?
Yes, the answer is yes. It's a little bit variable because of states, what state the folks are in, but it's the same concept state by state. Almost every state has a progressive tax system, if you will, which is along the lines of what you just discussed. And so these numbers, 300 and 200, so $300,000 AGI with a $100,000 loan is about the smallest that the system can handle, if you will, from an economics perspective. The it's also true on the cost of collateral, which is the insurance policies. If a policy is smaller, the insurance company and the insurance broker still have to do the underwriting, and they still have to issue the policy. So the kind of administrative costs, if you will, as a percentage of the face value or death benefit of the policy are a little higher when it's a smaller policy. So everything gets proportionately more expensive and less beneficial as the AGI is smaller and the loan amount is smaller. So currently at Donum, the smallest loans we've done have been in the $300,000 range.
Okay.
The loan is in the $300,000, which means the AGI has to be 500 or 580, something like that.
Okay.
But we're starting to see that we can start driving that down, and we've worked the math. We've done some internal, basic, if you will, spreadsheets math wise, and the $300,000 example in this example, 60% of the AGI would be like 180, 160. A loan of that amount would be about as small as.
Okay, that makes sense. So that was basically our floor. Okay,
yeah,
that helps a lot. Then let's talk about the lender. So share with me about qualification. Who is lending? What's the risk to the lender? Just how does that part of the equation work?
Yeah, so the lender, which in this instance is Donum, essentially on behalf of the charities who are the investors in Donum. Only charities are investors in Donum, and so the Donum is issuing the loans, and the risks are that the collateral underperforms. There's relatively little risk of non-payment because of how life insurance works, right? So not only is Donum's charitable lending fund listed as the primary beneficiary on the policies, but it also has what's called a collateral position, and it's just a fancy term for we've taken a security interest in that life insurance policy, which means that the beneficiary cannot be changed and the policy can't be sold or cashed out or borrowed against without the lien holder, us, knowing about it and being informed and frankly paid for it. So as a result, there's really quite a modest risk of non-payment. The greatest risk is if a decent percentage of the borrowers pass away early, because then the policy will not have had an opportunity to grow to the level where it can fully satisfy the obligation. But it becomes a sort of law of large numbers thing, because once one has a high volume of loans, which are then backed by a similarly high volume of life insurance policies, some people will pass away early, perhaps in a car accident or of an aneurysm or something. But then other people will live to age 90 or 100 or 110, right? And so it just kind of is how the cookie crumbles. One other piece to this too is there's some fascinating statistics around those who are philanthropically minded and also those who use complex financial assets or tools like this, and also their health. They tend to be somewhat higher or better health than average, because it's one of those, these patterns that if one pays attention to the details in one area of their life, they are statistically more likely to pay attention to those details in other areas of their life, and health is one of those other areas. Yep. So folks who are in somewhat higher tax brackets, right? We're talking essentially the 4 highest tax brackets, because below that, it's not efficient anymore, as well as who are more philanthropically minded and technically minded, tend to be healthier on average. So again, it's still the law of large numbers, and there still could be, folks who borrow who pass away early for unexpected or unforeseen circumstances. But on the whole, the charities who invest and relatedly Donum, who is the managing, the manager of the LC would see those returns be adequate on the medium and long term.
Okay. And then what's the return typically you're seeing for the lenders?
Yeah, so depends on the exact note that is underlying the asset and what's happening, but typically the notes bear between a 2 and 5% interest rate. There's a little bit of variability depending on a number of factors, including, among other things, the applicable federal rate under Section 7872 of the Internal Revenue Code, as well as on whether the fund where the capital was sourced was a program-related investment fund or whether it was a market rate investment fund. Those, of course, are different things and subjects for a different podcast altogether. But there are, and some of that just turns on where is there available capital at the time that the loan closes, and some of that will be dependent there as well.
Okay, wow, really fascinating. And do you find that is there decent demand? Obviously the fund has been created and an organization has been built. Are you finding that demand is continuing to grow?
Yes, the demand is actually outstripping supply. And we have very recently, and I can't say which bank yet because it's not live, but here in just a couple of weeks, we anticipate going live with a relationship with a bank where the bank is providing the capital that we will then use to issue loans and facilitate these charitable gift financing loans. But can't really speak to that one in great detail yet. It's not quite live yet. Another couple of weeks, as I understand it. We're very much in the advanced stages, but we are seeing significant demand. There are a number of borrowers who care more about, far more about the tax savings than they do the philanthropy. And there are some borrowers that are very passionate about the philanthropic aspect. And there's some wonderful case law that talks about for the purposes of charitable donations under Section 170 of the Internal Revenue Code, which is the section that makes them deductible. It doesn't matter if they care only about the financial aspect, because the code says if you give to a charity, or if a donor gives a real asset to a charity, and the charity receives it and gives the contemporaneous acknowledgement and all of that, if the gift goes to a charity, then it is permissible, perfectly permissible, that the only thing the donor cares about is the finances, because the code allows that.
Wow, was great.
That was some fun case law, because the IRS tried to really get into, were they charitable enough? Did they have a close enough relationship to the charity and this and that? And the court smacked the IRS really hard in that case, saying, whoa, it doesn't actually matter.
Donor motivation, right? Yeah.
Yes. They were going into donor motivation, and the court said, no. Did they do the things procedurally correct? Yes.
Yeah. So bring in the mind reader, right? If our mind reader says that your motives were wrong, we're not going to count it.
Correct. And the IRS, of course, applies the facts and circumstances test, which is essentially a non-test, and they'll consider anything. And it's the eye of the beholder, right? Yeah, no, all the nopes. So that was some fun case law for me to read as a recovering attorney. So.
Yeah. That's amazing. I appreciate it so much, Zac. And, if people have interest, they can just reach out to the Donum Fund directly?
Yes. Yeah, donumplan.com, I believe, is our website. Donum, D-O-N-U-M, plan.com. Donum, by the way, is a Latin verb. It means gift. It's where we get our word donor and donate and donation, and it means gift. So that's
excellent. Well, it's very eye-opening. I've heard pieces of it from different strategies, but not one where it's truly all been brought together. Especially the charitable lender, and I'm assuming even if you bring a bank into that equation, you'll still be able to maintain the charitable side of the lenders and have at least them coming into the equation as well. Yeah, very fascinating. Zac, so appreciate your time, and I'm sure you'll have questions coming up about this, and just want to thank you again.
Yeah, thank you.
Thanks for listening to the J.D. Levy & Associates Calibration Point Podcast. If you have comments or ideas for future episodes, please reach out using the contact page on our website, jdlevyassociates.com.